Hi, I'm Rebecca Venter. Today we're talking about the performance of the bond markets and why this is a great time to start investing in fixed income, and the answer to a big question we're hearing from financial advisors. Bonds have had quite solid returns so far this year. They've performed one of their very important jobs in investor portfolios, which is acting as a stabilizer against equity volatility. As we saw in the April time period, there was pretty significant volatility around the initial tariff announcements. And through that period, fixed income markets kept delivering positive returns, which helped investor portfolios weather those equity swings. After that, we saw that fixed income returns continued to climb throughout the end of the quarter. And we saw that the U.S. aggregate index actually ended the quarter with a year-to-date return of just over 4%. So it's been a really strong year so far for the fixed income markets. Across the bond market, we are still looking at one of the most attractive entry points for fixed income in decades. As of the end of May, Vanguard's 10-year outlook for bond returns, which is based on the Vanguard capital markets model, is projecting a 4.2 to 5.2% 10-year return for U.S. fixed income. Now, this is competitive with our expected equity return, but with roughly a third of the volatility. A lot of this is based on the fact that starting yields today in fixed income are very attractive. And this is the best indicator of an investor's total return, is their starting yield when they enter the market. It's important for investors from that perspective, but also important for them to understand the power of income. And that's really because income can serve as both a cushion and a hedge. So first, as a cushion, higher starting yields act as a cushion that set fixed income up well to be a stabilizer in portfolios. And we saw this through the tariff-related volatility in April. If we look at the taxable and the tax-exempt bond markets, these markets today now offer 2.5 to 3.5 times the income buffer that they offered compared to even mid-2021, before the Fed's most recent hiking cycle. Now, this means that if rates move upward, this has a less negative impact on total returns for those investors who can remain invested long enough to get the benefits of higher coupon income. Put a different way, even if we saw rates rise 50 basis points from here, returns over the subsequent year would be firmly positive for the broad bond market. This higher income also allows fixed income to serve as a portfolio hedge. From where yields are today, there's a lot of room for them to fall in the event of a growth slowdown or a recession. In this scenario, we would expect the Fed to step in and provide support, and that a significant decline in interest rates would lead to increasing bond prices. So for all of these reasons and the power of income in fixed income today, we think it's really important for advisors to be thinking about the important role bonds play in their client portfolios. One of the questions we're hearing most from advisors this year is, should my bond portfolio be globally diversified? We've seen this come up a lot as there have been significant trade policy changes this year that have led to some global disruptions. And we've also heard the question of, can U.S. exceptionalism continue? Regardless of any of this, our answer to the question would be yes. International bonds provide a really important source of diversification in a portfolio. This is because as an investor expands beyond their home country, they get exposure to a much bigger number of securities, to different inflation and economic environments, to countries that are at different points in the economic cycle. We've seen that these different factors have imperfect correlations over time, which means that by getting exposure to these different factors through different countries, it can help to smooth an investor's return. It's also necessary to have this diversification as investors' local markets can often have particular biases towards different fixed income sectors, credit quality, and maturity profile. For example, if you live in a certain country, a lot of the bond issuance in your country may be in the financial sector. Or you may invest in your market and get really exposure to just high quality bonds. But by expanding globally, you can get a much more diversified set of exposures in your portfolio. For Vanguard, we've seen through our research that a roughly 70-30 split of 70% U.S. bonds and 30% international bonds that are hedged to an investor's domestic currency, that's been a real sweet spot for maximizing these diversification benefits and achieving the best risk-adjusted return. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.